Well, the U.S. Released their inflation numbers this morning. They're not exactly what the markets were looking for, or more importantly, probably not what the Fed was hoping for. Inflation in the U.S. did edge up slightly, up to 3% now in January. That's a little bit above December's 2.9%, and it did come in above expectations of 2.9%. So the big question that comes out of this are interest rate cuts still on the table? How quickly will that happen in the U.S.? Let's break that down here. First of all, let's look at the big picture. Overall, inflation did tick up, and while the increase was pretty modest, it does signal that the progress we're seeing on the cooling prices might be slowing down a little bit there. Energy costs, as they always do, they played a pretty big role. They rose 1% year over year. This is the first increase there now in 6 months, so that might be a turning point. Gasoline prices, they did fall, not as much as before, though they fell 0.2% versus 3.4% in December. And used car prices also rebounded, plus 1% versus the 3.3% decline in the month previous. Now, meanwhile, the monthly CPI, that rose 0.5%. That's faster than December's 0.4% and came in well above forecasts, which were 0.3%. If that weren't enough, core inflation, which strips out food, energy, the more volatile sectors of the economy, that unexpectedly rose to 3.3% instead of cooling to 3.1%, which was the expectations there. So we have a lot to unpack. Let's dive a little bit deeper into this. Where is inflation picking up the most? Well, energy, as I mentioned, the costs were up 1%, and that reverses that 6-month downward trend. Fuel prices did still drop, but by much less. They're down 5.3%. That's compared to 13.1%. Natural gas prices held steady at 4.9%. Now, transportation costs, they also accelerated. They were up 8%. That's up from 7.3% that we saw in December. Shelter, which is, of course, a major inflation driver, that was up 0.4% month over month, and that contributed to nearly 30% of the total increase. Now, on the bright side here, we did see food inflation staying flat. That was at 2.5%. So that does offer a little bit of stability. So the main takeaway here is that we are seeing some areas stabilizing, but we're seeing key areas, transportation, shelter, energy, they're keeping inflation elevated, probably a little bit higher than we would like. So bring it all back around. What does it mean for the Federal Reserve? Well, the markets had been betting on more interest rate cuts this year, especially with inflation cooling in late 2024. But there's no question that this report complicates that equation. We now see this surprise increase in core inflation. Then you combine that with the monthly rise in CPI, and that could make the Fed hesitate a little bit before cutting rates anytime soon. Now, before this data, a lot of analysts were expecting that the first major cuts would come as early as May or June. But now that timeline has been probably pushed back. When I look today at the Fed Watch rate tool, the odds of a rate cut in May are now only 11%. So 89% are still betting that the rate will stay at the current 4.25 to 4.5% range. June, again, the odds are almost 69% of no change. And it's not now until September that the probability of the next rate cut even goes over 50%. If inflation keeps creeping up, the Fed may have to keep rates where they are now for longer. And that, of course, is not exactly what the markets wanted to hear. The question I guess I have, is this just sort of a temporary bump, or is this a sign of stickier inflation ahead? What do you think? Drop your thoughts in the comments. Now, I want to talk about rent prices in Canada dropping here. But first, I just wanted to mention that yesterday I had a great chat with Adam Bornn. He's well known to a lot of Canadians for his expert financial advice that he gives out on Parallel Wealth, which is one of Canada's top retirement-focused YouTube channels. And together, we're launching a brand new monthly episode on my Beavis Wealth podcast. So every month, we're going to be answering your biggest questions about retirement. And these questions will be taken straight from my YouTube series called Second Act. And this is a 12-part series on everything that you need to know to prepare for retirement. Episode 1 of that series is now live. Now, if you haven't watched it, you can go check it out. I will put a link here. Yesterday, Adam and I covered off the whole planning stage, and that podcast will be live a little bit later this week. So you can watch episode 1 of the series now, then you can tune in to Beavis Wealth Podcast to hear our answers to your questions. Again, I will put a link so you can join that now. Now, in Canada, we have seen a dramatic shift in Toronto's rental market from last year's bidding wars that we saw. There's a lot of units that are just sitting vacant now. some cases for many months. And a big concern there is the US President Trump's proposed 25% tariffs on Canadian goods. And a lot of analysts are saying that that could weaken demand even further than where it is today. Now, rental prices in Toronto, Vancouver, they have already been dropping for over a year. The Toronto prices are now down 7.6% from their peak. Vancouver's down 13%. When we look at this on a national perspective, rents are still 16.4% higher than 3 years ago. But if we do sort of end up in a recession that's triggered by the tariffs, that could push prices lower. Now, CIBC's Benjamin Tal, he notes that while the newly implemented steel and aluminum tariffs may not have a major impact, if we see a full-scale tariff war, the potential for Canadian retaliations, that could hit GDP by 2 to 3%. And he notes, historically in a recession, rent inflation slows down. He also notes that rent prices may have already hit their peak affordability, and he says that with weakening international migration, increased rental supply, they're also pressuring the market. So we find ourselves here sort of at a place where there are a lot of Toronto landlords, and especially in the condo space, they're struggling even now to fill vacancies at the advertised prices. So there's a number of them who are reducing rent to sort of keep current tenants from looking elsewhere. And that's something, of course, that was almost heard of, or almost unheard of, rather, not long ago. Now, it's pretty hard to get a consensus on practically anything these days, no exception in this space here. And not all experts are believing that rent declines will in fact last. And an example is Giacomo Lattis. He's of rentals.ca, and he warns that tariffs could actually drive prices up in the long run. He says that a trade war would raise construction costs, that would cause developers to delay or cancel projects, and that could lead to supply shortages by 2026 or 2027. Now, my last story of today revolves around Bell Canada, and they are offering voluntary severance packages to 1,200 unionized employees. They're saying it's due to unprecedented challenges in the telecom industry, and the company is launching what is called an enhanced voluntary separation program to give eligible workers an option to retire or seek other jobs. Now, of note here, Bell Media employees are not included in this offer. A company spokesperson said that shifting customers to newer fiber networks has led to reduced workloads, and that requires fewer staff. Now, Unifor, the union that represents Bell workers, obviously is strongly opposed to this decision. Lana Payne, who is Unifor's national president, she says workforce reduction plans are a damaging stunt to temporarily reduce costs, making profits appear higher on the backs of workers. Bell cannot keep cutting jobs every year and expect the ship to turn itself around. She also accused Bell of cutting Canadian jobs while expanding into the U.S. She says there, Bell has chosen to once again leave Canadian workers unemployed in part to satisfy its move into the American market. Clearly, there is no love lost there. Now, the broader telecom industry has been seeing a lot of major shifts. We've seen companies dumping assets, cutting costs. And in fact, Bell's parent company, BCE, they have been aggressively restructuring. This includes the sale of its 37.5% stake in Maple Leaf Sports and Entertainment to Rogers for $4.7 billion. It also purchased U.S. telecom company Ziply. Now, meanwhile, Rogers, they have been facing internal conflicts over its leadership, and that has led to further increased volatility in the entire sector. Now, back to Bell for just a moment here. This new announcement isn't the only example of downsizing. In fact, jobs have been cut at Bell. They have been ongoing. In June 2023, the company eliminated 1,300 jobs. They followed that by a February 2024 announcement, 4,800 layoffs there, and the closure of several radio stations. There were additional layoffs in June of last year that targeted the technical staff. So now this latest round of voluntary buyouts is just another step in Bell's ongoing efforts to cut costs. Now, with the Canadian telecom market in a bit of a turmoil here, I certainly wouldn't be shocked if we see more structuring before too long. That will be a wrap for this program today. If you haven't already subscribed to our podcast, go ahead and do that now. I will put a link here that you can join and follow Adam and I as we talk about your retirement questions. Thank you so much, as always, for watching this show, and I look forward to seeing you in the next video.